Welcome to the Tower Wealth Advisory podcast series. Today we're speaking to a company based right here in Alberta, actually headquartered in Calgary, Canoe Financial, an investment firm right here. They're over $11 billion in assets now, and we've been fortunate enough to wrangle in a couple of their portfolio managers to speak about the energy markets. So we will be speaking to Rafi Tamazian here. He's a senior portfolio manager and director with Canoe Financial. He's got over 30 years experience in investment management, corporate banking, and oil and gas. And we're also going to be speaking to David Sabunka, also a vice president and portfolio manager on energy equities. He's got 14 years of experience in portfolio management and energy equity analysis. We're looking forward to chatting with these guys. We had a great seminar with them online that went smoothly. However, we missed a bit of the recording. So you're coming in at this point about 3/4 into our conversation with them. So enjoy the seminar that we have recorded here for you. And if you have any questions, reach out to us at towerwealth.com.
So you're in an environment today where they're all trading super cheap and you don't have to chase high risk stocks. You can stay parked in the very low risk stuff today and ride this strategy out with us.
Yeah, this just tells us it's super early because normally the best in class, let's say, trades at 8 times, and then the low guy trades at 3 times with all the different attributes that we don't need to get into. But this just tells us there hasn't been eyes on the sector in a long time. And then as people come back, you're going to see these multiples. 2021 was kind of all boats lift. 2022 is going to be multiple differentiation within the stocks. And you really got to know which assets and multiples and companies are going to expand here.
So the funds that we own, there are 3 strategies. There's the Alpha Fund. It's got a long short book to it. It's got all of our private equity, aggressive private equity, because we put private equity in all 3 of our funds. It's got a fixed income component and it's got an option book. So, it's got different vehicles that can allow us to drive up and down the risk. We can actually start to make money in negative markets as well. We've got a 6-year track record with this fund with I think it's over 18% annualized return. It might be north of 20% right now, Wayne, I'm not sure. And I encourage those who qualify to be able to participate in that to take a long, hard look at that fund. The long-only funds that we have, the strategies are the Canoe Energy Fund and the Canoe Energy Income. The Energy Fund, in a period like when Dave and I are constructive in energy like this right now, you can imagine we're full bore, aggressively pursuing our subsectors. The Energy Income Fund, just by its nature as a dividend fund, gravitates towards the higher, the more secure yield names. It allows for you to have a softer trough, but it also means a softer peak as you're investing. So maybe it's for those who want to invest, need some income, and maybe a little weak of heart in terms of participating in this sector.
Where do you want to go here, Ralph?
Well, maybe I just want to talk about the all things energy. I think it's important for people to understand one of our subsectors that we talked about earlier is the alternative energy and energy technology. And this is not a time when you should be putting capital into that sector. The stuff that ran through hype and government incentives and misleading projections for the last 5 years is all falling apart right now. And you don't want to be anywhere near that stuff. But Dave and I, when we started to look at this sector in the middle of that cycle, we certainly weren't going to go after it either. In fact, we just accepted we're going to try to figure out what's going to happen in the next cycle for that group. And what we found was battery storage, the ability to store that ridiculously inefficient power of wind and solar, is going to have to be the thing that cracks the nut there. And fast forward today, we've got control of a company based out of Ontario called Hydrostore that is on the leading edge of bulk battery storage. And this is a company that is attracting now some of the biggest private equity names in the world to look at it from a value perspective. And it's peppered into all 3 of our funds. We have Arias, which is a company that we own 20% of that company. We are on the board. I chair the board of that company. We took a guy from Canada who has water recycling technology and knowledge because Canada's a leader in that area. in water recycling in the oil and gas industry, and we plopped him down in the middle of the Permian Basin. Guess what? They're sucking onto him like a leech. And our EBITDA after 4 years is going to be 5 times our EBITDA in Canada next year. It's an extremely well received, and all it is bringing our knowledge down to their basin. We recycle virtually all the water we produce in Canada. The US recycles only 10% of their water, and they use a vile amount more water on an absolute basis than we do. So it's a problem. Injecting their water back into the ground is causing earthquakes, and New Mexico has halted it. Well, halted new water, and they've slowed down the pace of injection of water. So we are front and center on the new, making the current industry of fossil fuels better through recycling. We're trying to help the alternative energy area with Hydrostore. We've got a couple other things. This Canary Biofuels is a third crack of trying to create a strategy of biodiesel that we grabbed onto the third crack on it. So the first one 10 years ago went bust, second one went bust. We bought into the business that bought it all for 10 cents on the dollar. Have had a very good result so far in that business. Altius is a public entity that's grabbing royalties off of these inefficient wind and solar businesses. And so the risk there is mitigated by being the royalty side of it. These are all ways that we can introduce to you how to make money in that sector now. And this is going to be stuff that's going to be talked about when that cycle rebuilds. This is not a time when you should have 80% of your assets in this area. This is where you're planting the seeds for the next cycle. Right now, you should be full bore into fossil fuels. I'm saying it that way because you hear a lot of people complaining about, or saying, a lot of these pension funds saying, we're no longer going to invest in fossil fuels. We're going to invest in these crazy experiments in the alternative energy space because it's the right thing to do. I don't think that's correct. As an investor, is your fiduciary obligation to look for how your money should be spent for the good of the earth? I think that what does that mean? Does that mean I should be throwing my money away? You should always be looking for what is the best investment. And it's not that you're not going to invest means that there's not going to be hydrocarbons in the world. Our government tried that. By us not producing 1 million barrels more of oil over the last 6 years, does that mean there's 1 million barrels less being produced in the world? That means 1 million barrels more are being produced by a dissident nation with a human rights tracker that's abysmal and environmental standards that don't come close to ours. The world ended up worse off by Canada not producing oil than better off. I'm going to leave it there. We have some slides in here that I'll encourage you to look at that'll break down the subsectors that we're focused on today and the weightings of them. We talk a little bit about some of the names that we own in there as well. Encourage you to look at those slides, but really it's 11:46. I want to make sure we get to any questions anybody has. Hopefully we've created some of those.
All right. So if you have some questions, you can key them in at the bottom of your screen. There's a Q&A button, so you can click there and ask your question, and we'll relay them. We're going to start off with a couple questions right now. Great presentation. I think this is something that we've been talking about with our clients for quite some time now, and it's hard to get back into that side of the world when you've been out of it for so long from a portfolio standpoint, but I think it's going to have a good spot going forward for many years for us, though. So let's go with, have you seen foreign institutional money flow into the sector?
Yeah, so foreign institutional money, I don't know if I can tell you comfortably that that's happening aggressively or not. I would say no. Domestic institutional money was elevated in the latter part of the first half of this year, and we're seeing it elevate again because these companies are all starting to enter the index again. They were all thrown out of the index, the energy index, when they fell below a threshold of market cap and how that's calculated. And now they're all rebuilding and they're piling in now, and these index hugging funds are starting to buy into them. that was our point earlier, where you want to try to be ahead of that, and you want to try to be piled in so that you're actually handing your equity back to them as they bid the price up. So we're seeing it, and it's a product of really both awareness of the profitability of the sector and conviction around the distributions and the index inclusions.
The one thing I just say that's notable on that too is, so you're seeing capital enter the sector because of what Rafi just said. But if you just play out what's even happened here in the Q3s, Suncor doubles the dividend. Cenovus doubles their dividend. C&Q raises their dividend 25%. Paramount triples their dividend. Like, the rate of change going on in producer land is very, very big and to the positive. Rate of change is awesome. But on the pipe side, TransCanada's lowering their dividend yield from 5-7% annualized growth to 3 to 5%. Gibson misses the quarter. Keyera misses the quarter. Like, this is where the big institutions are parked, in pipeline. And the rate of change is now really changing to go producers. So we're even seeing these pipes become an ATM to chase that producer side of the equation too.
Great. Want to go with one there?
We got a few questions coming in here, guys, so I'll just read one off to you. One of them here is that they strongly agree with you that global demand for O&G remains strong. What are your thoughts on the disruption caused by ongoing political influence or even the suspected globalist narrative?
You really want me to answer that?
That's why we picked that one out of the list.
We picked that one, yeah.
Yeah. So look, I mean, I made this comment yesterday on a newscast as well, that it was an interview where I was kind of cornered on it. And, you know, I believe, you know, young people have the luxury that this government is going to be gone, and there's going to be 5 other governments probably in their lifetime that will ebb and flow towards the middle. I'm older and I have to deal with only a few governments left in my life. So this one has a bigger impact on me, and it's frustrating. And the reality is, you've got a situation where this government has moved the needle on policy and agenda that is contradictory to the GDP of our country, which is the energy industry. And it's an energy industry we should all be very proud of, not embarrassed by. And nobody is doing anything to try to help that. We have to let time pass, and the misrepresentations that this government and the people they're allowing into our country to create these misrepresentations to be evaded by, probably it's going to require a new government to do that. So we got to work within the confines of what we have.
Yeah, very true. I thought you were going to go on a deeper.
I could have, and I'm, you know, there's so much, but we have a hard stop in 9 minutes.
Rafi, yeah. I'm proud of you. I'm proud of you, the short answer.
Oh man, my tongue is bleeding.
I got another quick one here for you, Rafi and David. How is your fund different or better than common ETFs such as NNRG or HXE?
I'll let you answer that, Dave.
Yeah, like, the thing I would tell you is, there used to be 58 names in the TSX Energy Index. Today, there's 14. When you buy the TSX Energy Index, you're pretty much buying an oil sands fund. And we started the presentation with, we own subsectors, and we think there's times to own a lot of heavy oil. But then there's other times that you really want a lot of service and then gas, and you move this capital around, and we've had a very successful track record doing that. And so that you get this moving around of capital with our funds. And like we told you, it's not to say these large, like 2020, even 2020, 21, you never really got paid for the risk that you took, which is why we really propelled our funds into the flight to quality and liquidity, CNRL, if you will. And when CNRL goes from 15 to 40, 50, that's a pretty good return. But if CNRL goes from 50 to 100 or 50 to 80, we think that how we're positioned, our names are going to double, triple, and quadruple because the sector's thawing. You can now see today people taking more risk. They're underperforming the index. They're chasing performance, and they go to buy more risk when that's all at the backdrop. And we're positioned in those names like we talked about for various reasons. But that makes us a lot different than the index.
So the other way to put it too is we invest in subsectors, and they move around, and the indexes don't do that. The other thing is that we have private equity and they don't have it. And we also have energy transition investments. And I don't share that slide where I showed you 8% of our assets lightly there. It might be 8% of our assets, but it's a lot of work and a lot of brain capacity for us to understand that sector. But we just want you to understand the complexity of our funds. They're far more complex than an ETF. It was a good question, though. I mean, I think that's what we're ultimately trying to get across in this presentation.
Yeah, and I think that is coming across in the presentation. There's a deep amount of work, obviously, that goes into selecting the funds that fall in here. One other question here, I guess, if we have time, guys. How are you guys doing on time?
7 more minutes.
Yeah.
7 more minutes. Oh, that's tons. Okay, so we had a note here. How will the environmental and emissions climate control commitment just made by our government affect your funds? Or will it?
Yeah, these are all things that Rafi and I think about. There's going to be a lot of investment in Alberta in the coming years, like carbon capture, hydrogen, all these various things. Like, we are super bulled up on Alberta. The commodities are turning, gas prices are the highest they've been in 15 years. Oil prices, like the royalties being spun off to governments, is through the charts right now. And then on top of that, you have billion-dollar investments being made in Fort Saskatchewan on new facilities to produce different petrochemicals. You have carbon capture coming. Like, just look at the press releases from Shell, Petronas. They're piloting CCS in Alberta right now. All of this is going to be bullish Alberta and a lot of spending. And there's ways to make money on that. I think there's ways to make poor investment decisions on that as you try and chase the cost of the gadget lower. But we're finding ways to bet on the spend. And the spend's going to happen. And that's where Rafi and I position the funds. And so that's just our overall view of that part of it.
Maybe just talk about gas too. Gas is not oil. And we are a gas basin and a heavy oil producer. We're not a light oil producer.
Yeah, I was sharing with Rafi earlier today, we were listening to a Goldman Sachs put on a call on carbon economics, and you listen to these big super majors, Total, Shell, BP, all these guys. It's like they talked ahead of the conference. They all keep saying the same thing. Natural gas is the transition fuel over the coming decades. And we share that view. And so Alberta is different than the US, or Canada rather is different than the US. 70% of our basin is natural gas. And we have heavy oil in a market where there hasn't been a new US refiner built in 20 years. And they need heavy oil. Again, these are all pointing you towards, as egress is showing up in Western Canada, TMX, LNG Canada screens really, really well. And those are the things that are happening versus the US is light oil and not really that much gas relative to activity within the US. So these are all things that screen Canada really well.
Nice.
Great. We do have one other question here that maybe we can get to, a question from one of the attendees here. Why is Canoe not considering the value of distributed sensing of energy and infrastructure being advanced by companies like Silixa? The overlooked importance of monitoring gas emissions, CO2 injection, and seepage during dam construction is an emerging tech that's growing exponentially. Is this something you guys have been looking at or exploring?
No, I mean, look, I guess you have to look at, I get exposed, Dave gets exposed to a lot of opportunities. And for the last 6 years, our patience around our capital has been high patience. Our capital's patience today is low. So I don't want to put capital to work that is going to be technology that has risk and is going to be a time period before we see the opportunity. Because today, the public funds right now, there's massive money to be made. And so it's really hard to deploy capital that isn't going to start generating cash immediately for us, and that the risk of that capital being reached, that return being reached is basically zero. So the time to be putting money to work in new ideas and patient capital is not right now. You should be putting it into public stocks that are trading at these lifetime generationally low valuations. Is that a fair comment, Dave? Am I right?
Yeah, you answered it bang on. And the thing I would say is the few opportunities that we have looked at on that, like if we see doubles and triples in the publics based on what we're saying and how we think this is all going to play out, multiple expansion, dividend yields, that sort of thing, those few ideas that we have looked at, some of these technologies, think of it as almost like venture capital, where we need to see the potential for a 10 to 15 bagger to allocate any dollar to that, because it just doesn't compete as a 3-bagger relative to our publics.
Gotta go where the money is.
Yep. Do we got time for one more quick question here?
Okay. Hey, we got to go then. We have another presentation. In
Yeah, I know you guys have got to jet off. So thank you very much for attending. We'll let you guys sign off and we'll wrap up on the housekeeping items here on our end. But thank you very much to Dave and Rafi from Canoe Financial. Guys, we appreciate your support and very interesting funds that you're running there.
Thank you. Yeah, I thought those were great questions too. Appreciate that.
Thanks for the time.
Thanks for watching this episode of the Tower Wealth Advisory podcast series. There will be a link to the full presentation below.